What's going on, everybody? JT here, and we are back for episode 2 of Markets Unboxed with Ed Lashinsky. Super excited to get this show on the road. We're going to be talking about all sorts of macro indicators, relating it back to crypto, as I'm sure many of you have seen. The crypto markets are looking, more exciting than they have been over the last year and a half or so. So we're going to dive into some indicators, some trends that we're seeing in the macro market, relate it all back to crypto, and see where we go from there. Ed, how you doing?
Good. How about yourself? Great to be with you again.
I'm doing fantastic. Appreciate everyone tuning in at this early hour. I know, a lot of our audience for myself is here in the States. So good morning to all of you. Good evening, good afternoon to wherever else you all are tuning in from. Feel free to leave a chat in the live chat. We'll be keeping an eye on those, whether you have questions, comments, anything of the like. Be sure to like, subscribe, and let's dive into what we're checking out this week.
Fantastic. Well, it's been, I think, about 2 weeks or so since we last spoke, and there have been a lot of changes in the market since then. Not to overstate yesterday's newspaper, so to speak, but the reality is we've seen a pretty significant paradigm shift, and this has been led by the Federal Reserve, the monetary policy meeting that they had, the subsequent remarks by Jerome Powell. And the data that we've actually had as well. So it's been a combination of these factors, and all of which have been coincident following the Fed messaging that basically, while they still may hike rates one more time, the bar for doing so is now much higher, and they are increasingly concerned about a sharper or sooner than expected economic slowdown. This is something that's my interpretation. They haven't explicitly said this, but reading the tea leaves, looking at the evidence, the reactions, how they react, what various Fed officials have been talking about, how the market's been interpreting that. I believe that there's a growing concern with the prospects basically that you have an imminent economic slowdown, that it lasts these so-called lagged effects associated with the sharp increase in rates and tightness of monetary policy are actually starting to be felt around the economy. So
weren't the GDP expectations basically cut in half since the last time we spoke?
Yeah, that or perhaps even more. I haven't seen the latest Atlanta Fed GDP Now numbers, but those. So it is basically. We came in at 4.9%. Inventory build was a big part of that. That should also be reversed quite sharply. Right now, the latest estimate as of about a week ago was 2.1%. That's the current number now. However, I've seen numbers actually sub 1%. So really? Certainly that's going to be coming down. It appears that, again, much of the data that we've been seeing, and I think one of the big things that shifted this was the unemployment numbers that we had. So in what you're seeing there is a general softening of the labor market. So not only did you see job openings increase that preceded the report, but in the report itself. And by the way, as an aside, the household survey, so this report consists of two main parts: household survey and establishment survey. Most of the market and people will be looking at the establishment survey. However, the household survey also has shown a now reasonably sustained weakness, which was to some degree contradictory to the establishment survey. But now you're starting to see.
What's the main difference between the two surveys? If we could.
The household survey is conducted by a survey of households, as it suggests. Right. And the others is done by a survey of businesses, and it's generally speaking, it's considered, and these will also be revised over time, and there are a number of different things about the methodology of that. But essentially, the the data as it comes from the businesses is viewed as more efficacious overall. But the household survey data. Again, like Fed has like 100 statisticians on there or more who are crunching these numbers and going through it. And so where the household survey, for example, will take a survey of households as it suggests, and with a reasonable standard of error, they will come up with numbers about what the overall situations is looking like. The actual non-farm payroll numbers are the actual reported jobs. And so those are and again, those will be also revised as well. Usually with there are a couple of monthly revisions, and then there's an annual revision as well. I haven't been involved in statistical analysis of this for some time though, so do fact check me on a couple of these. But basically, that's kind of how it works. And so, in general, the market will pay more attention to the establishment survey than the household survey. Of the establishment survey, the main components of that are the hours, hourly wages, hours worked, of course, the number of non-farm payroll, or the number of workers added, and again the labor force participation rate as well. There are basically four main factors of this, and of course the number of jobs added is always the headline number, which is usually the most important. If it wasn't for the government, this number would have been very weak. You had also had some revisions that were net lower. So it's clear that the pace of job creation or hiring is going down. You also had hours worked shift a little bit. You had wages that came in slightly softer, and you also had an uptick. You had a downtick in labor force participation rate. So all of these were conspired to lead to a general conclusion that the labor market is starting to weaken.
Right.
And this is it's not a surprise, and it appears to be corroborated by wider other macro indicators. The inflation data we also had indicated in general was a bit weaker. PCE is starting to come is fallen actually quite dramatically from the peak. So the Fed, I think, they can't send an all clear signal. In their last FOMC meeting, they cited a tightening of financial conditions as being material to their current assessment on the need to move rates. In other words, we had a 50 or over 50 basis point increase in longer term interest rates in the preceding weeks. And this, to some degree, a lot of people will have different reasons why they think, or different contributing factors behind this, whether it's increase in term premium, whether it is a higher for longer expectation, which is a consequence of that increased term premium, and the market essentially saying, okay, the Fed's not going to be moving rates down anytime soon. In fact, they're going to be held up higher for longer, and therefore longer into the mid to longer into the U.S. Treasury curve, rates need to go at least up, and the curve, in fact, de-inverted, as they say, and the yield curve got close to flat, or positive in some cases. As the long end rates went up and the short term rates kind of stayed reasonably stable.
So do you think we'll actually see at least one more rate hike from the Fed?
No, I don't think so. It has never been the case historically, as far as I know, and fact check me on this as well, that once they have stopped for this period of time, that they actually renew the hiking again, unless something significant changes. So what seems to be happening right now is that not only is inflation coming down, the job market's starting to weaken, it looks like, but you're also seeing some of the tightness of these credit conditions. Now, even though you did have, following the market's euphoric reaction, rates, stocks, almost everything that touches on or prices Fed liquidity and interest rates had a significant response post that FOMC meeting, and then it was further supported by the jobs number figures that came out 2 days later. But basically, the markets were also technically offsides in terms of their positioning as well. So again, you kind of went from one extreme, and so the very conditions the Fed cited, which were tightening the financial conditions, specifically mentioning the sharp increase in long-term rates, where 10-year yields got above 5% briefly. Then 10-year yields subsequently went back to 450. So they kind of took out some of that tightening the Fed had used. But the reality is that the Fed will look at the overall conditions. And by the way, we also have seen some inflation expectations from University of Michigan last week rise. I don't think that that's overly material. Those numbers have been around, and they do, and it is noteworthy, but they have not been. There are a number of other inflation expectation gauges the Fed will look at as well. There are two or three other things. This is one of them, but basically they've not been actually that causative as it relates to actually shifting the bar on the overall inflation story. And anyway, so the point is that we're dealing with a situation where the markets have believed the Fed is done. The Fed has kind of said we're done. They can't say that we're done because they still have egg on their face from 18 months ago with these transitory inflation effects. The issue, though, is that you've had a lot of the supply shocks, and those supply shocks have mostly been ameliorated now. Fed is, of course, can only affect the demand side of the inflation equation, which they are now starting to do. With the decrease in core personal consumption expenditures, and there's a feeling that basically that productivity is actually increasing a bit here, and that with the sustained higher level of rates, with inflation falling, your productivity is increasing, and in fact, it's keeping conditions tight, and therefore the Fed does not need to tighten further. If we get into a situation where inflation begins to come up again, then we'll see what happens. It's not at all an unreasonable idea. However, we are seeing a lot of growing headwinds around the world economically. Europe, China, US. US not as much, but you're starting to see some key areas begin to changes of consumer behavior at the lower level of consumption. You're starting to see, and you will see, significant distress that rises in the corporate sector, particularly small and medium-sized enterprises over time as they reset the rates and their borrowing cost. And it's a two-pronged problem. One is where their borrowing costs will go from 3 or 4 to 9, 10, or 11, maybe 12. And at the same time, the banks themselves will be becoming more specific about their extension of credit too. The latest senior loan officer survey was not as tight as people had thought, but nonetheless, this is still an ongoing issue. And what we will see will be, and you're also at the same time seeing a really nearly unprecedented drop in money supply too, which is very interesting. So there's some strange things happening in the economy. And the point with all of this is that the fiscal side of the situation is starting to roll off a bit. It'll keep going for some time, but we've seen the bulk of the fiscal stimulus, I think, now is kind of behind us. It's not going to necessarily improve the government's position. I think we're looking at 6% plus deficit GDP for quite some time. Per estimates, there's also somewhere in the neighborhood of the next 36 months, 50% of the federal government debt will mature. And while recently the Treasury took a step back from increasing more supply at the long end, the supply situation is going to be an onerous issue for the markets. Moody's Friday downgraded or put on, I guess they didn't downgrade, but they put on credit watch negative the US credit rating. This was, it's more or less viewed as it's a big deal, but it's not a big deal because they're the list of 3. Fitch and S&P have already done it. And in terms of different contracts or different, all the different things that were tied to the credit rating are not so much there. So I don't expect it to have any kind of lasting impact. It's more kind of again, an optical thing. Clearly, it's
the headlines.
we have this government shutdown coming up possibly, and all the political, embroglios that are occurring right now, which is absolutely unproductive for the U.S. economy.
Seems to be that way every time they're discussing the budget. Honestly, they can't come to any sort of decision, and we're always in the threat of a government shutdown lately.
Yeah, and the big issue that we have as well is that with the with the federal government, with the cost of servicing the federal debt, I think the projection is something that it will rise if rates go up to somewhere. If they stay the same, I have to get the numbers specifically, but I think if they go up to somewhere like 9%, it's going to be somewhere like, okay, if they stay the same, I think in the next 5 years, it will be 25% of the federal debt. And again, fact check me on that. But the point is that even if rates don't materially rise from here, and as they have to reset the duration of the portfolio, the debt portfolio held by the public in terms of it's not a debt portfolio, it's their borrowing, it's our borrowing, government's borrowing, right? But
Right.
that portfolio held by investors that is issued by the US government, the average duration of that is going to probably need to rise. And with the need to, it will rise. And the issue is in the next 36 months, 50% of 33.6 or $7 trillion of debt rolling off. And this is all debt that's rolling off from substantially lower interest rates. You will see the average interest rate rise significantly. That will impact the federal government's ability to spend. And you're going to get to a point where there's a so-called crowding out effect, which means that the actual service payments on the debt will begin to severely impact the government's ability to function and to spend on core services. So this is a big issue, and this is why the political problem right now needs to be fixed. And somehow we need to get something where there's a path toward reining in the spending and managing a budget deficit that can show some sort of no longer expanding, right? That you get something that at least is starting incrementally to decrease or diminish. And this is, of course, assuming, the CBO baseline expectations also are probably somewhat too optimistic. And this is assuming, and then the other concern, of course, is if we go into a recession, what happens, right?
Right.
I was just watching something by this Nobel economist who he won the economics prize this year. Is making some points about how essentially we're going to be going from crisis to crisis because the inflation situation and the 40-year secular change of lower rates now has shifted the supply demand. From a macro perspective the short story is the market and the economies have become much more sensitive to these changes, and the ability or the disinflation or deflation that has been prevalent for a long time is that threshold or that margin for error is no longer there. And so you're going to see a much greater degree of volatility in both directions. The concern is if we go into some sort of recession in the US or things slow down, and I think there's a prospect of this happening really fast, like much faster than anybody in the markets expect right now. That happens, the problem now is the Fed still has this credibility issue. They need to ensure that inflation truly is dead. You're still very far from target. So even though inflation, among a number of different measurements has dropped pretty sharply, we're still very far from where the Fed needs to be for their so-called 2% inflation target.
Right.
And we're not yet at a point where they can really wave the all clear and say, well, we're close enough. So
Do you
the
think
issue is,
2% is
yeah,
arbitrary in the sense like, I've heard a couple people question Jerome Powell on the idea of like, what if 3% was actually a good number? Like, why
yeah.
are they so steadfast
That's
on the 2% number?
that's a great question. I don't. It is completely arbitrary. So this was given or provided back, I think, about 10 years ago or so. And when the world was really consumed and concerned about deflation, you had Japan, you had the post GFC, you had the European debt crisis, and you had a lot of disinflationary forces around the world. And so the Fed felt that some small amount of inflation was desirable and good, and it gave them also a backstop. It was also the rationale for expanding the balance sheet and printing a whole lot of money, right? So it was, we have this target, we're very far from it, so therefore now we can effectively, one step remove, monetize the debt
Right.
for some period of time. And and that's kind of what happened, right? So and again, historically, a small but regular and consistent amount of inflation is to be expected, and is historically quite normal, and it's not at all unhealthy if it's consistent, if it is something that is regular, and it doesn't it's not sharply increasing or decreasing over time.
Right.
A big part from macroeconomic sense is that it's not so much the actual outright level, it's the speed or the rapidity with which things adjust that cause a lot of dislocations. And so, I mean, even in the current context right now, if you think about what's going on, you've got a lot of businesses that have to refinance their debt. A lot of them won't be able to refinance. They're already unprofitable. There's going to be a significant drag in that area. And then you look, for example, the mortgage market, and you have a tightness in housing supply, and you have refis at very low levels, and all of these things that are going on. And consequently, but because mortgage rates have gotten up toward 8%, right? And you have to, and so the market
In
now is
some places higher than that.
yeah, in some places higher than that, right? So, I mean, you have, and then we're looking at the situation back to the Fed, where the Fed still has this credibility issue because overall, the biggest issue, I mean, the Fed has a dual mandate, as we know, employment and sale prices. So, employment which was at effectively all-time lows. They wave the flag and say we won that one, but then the bigger issue, of course, is the corrosive effect of inflation, and how that over time can become embedded in the economy and people's expectations. And that affects then price behaviors, affects all kinds of things. And so that's where, and again, the Fed is very cognizant of the U.S. dollar's role as a leading is the leading currency in the world in that way, and so the stability and the basically the stability of the dollar and monetary policy is of paramount importance, and so that's also, again, we don't need to get into a lot of things happening in the emerging market space here, but as it relates to the dollar and what's been happening there, but clearly there is a very strong awareness of this need prima facie for the U.S. economy, but also for the rest of the world. As long as the dollar remains this global reserve currency, which it is, and there isn't really any. There's in fact, in my opinion, there's no credible alternative. You do have the euro, but you still don't have a fiscal union with the monetary union, and it is doing okay, but you still have it's maybe 99%, but it's not 100%. And because it's not 100%, and because you don't have a unified taxation authority in Europe in terms of issuing debt and doing these things, there are potential systemic issues that can arise in crisis, that can be very problematic. So far, they've done a tremendous job, and they're actually going to be coming out with the digital. They started the I guess investigative phase for a digital euro now, which will be interesting to see what happens there.
How do you feel
And
about that, just on a side note?
I honestly feel like I don't know enough, other than to say that not being either too far to the left or too far to the right, people will decry this as the end of financial freedom and privacy and everything like that. I wouldn't go that far, but if you think about a central bank digital currency, it puts extraordinary power in the central bank's hands, not just in terms of potential privacy or other issues like that. And there could be some ways to ameliorate that, which would be represent some sort of compromise ultimately with the public. But when you think about it, it means the central bank will know every single transaction potentially, or have a way to manage and track every single transaction. And to the degree that they're able to identify the various, the sources of these transactions, it gives them a massively powerful policy tool. And this isn't so much on the side of privacy or various human right concerns associated with that, but it's more, if you think about how much more efficient monetary policy could be if they know exactly where the money is being spent, how it's being spent, and everything like that. It's a very interesting idea. But it seems to me like we're dealing with something where you have, and this is maybe the public has to use it, right? And we have, and I guess what I'm not clear about it yet is how this kind of ledger system with a CBDC will ultimately enhance the government's ability to function. And I'm not I'm not as most of my time lately has been spent in DeFi, working through
Right.
option strategies and trying to figure that out. So I haven't been spending a lot of time at CBDCs lately.
Do you have any
Um,
alpha to drop on the DeFi end of things?
I'm sorry.
Do you have any alpha that you could drop on the DeFi strategy end of
I
things?
mean, I think what we're seeing right now, I mean, again, this macro backdrop, just to finish that up, is that we're seeing,
Sure.
so the Fed is unlikely to lower rates even if the economy weakens because they have a credibility issue they need to be sure about. And they're not 100% sure. And it will be twice as bad if the economy slows and inflation slows and they say we're done and then it picks up again. And then everybody's going to freak out. And even if it doesn't pick up a lot, they're still going to freak out.
Right.
And that's going
And
to
then
be
the Fed
really,
loses some credibility too.
and it's going to be really deleterious for the markets as well because it represents uncertainty around capital flows and what people can expect. And so when you look at the rate, the risk-free pricing that we have right now, so the market's pricing about 100 basis points of easing by starting mid next year to the end of next year. The Fed's maybe half of that or so. The point is that there's an expectation of the economy weakens, the Fed will respond as they have historically done. However, again, because we have this situation where inflation is so far above target, and there are still a lot of issues that could potentially affect the supply side, that they will be, I think, rather reticent to cut rates until things are truly screwed up, or until you see, unemployment back above 4.5% heading toward 5%. The markets, of course, are going to react much sooner, and they will consecutively price in. But what I expect may happen, somewhat counterintuitively, is you see mid to longer term rates actually decline more than you see short rates, which would be called the bull flattener. So in other words, the yield curve would be going back further inverted, in this case with lower yields, and where you see short-term yields that are sticking around 5% or maybe 4.75% if things really get out of hand. Which was still pricing an interest rate ease, by the way. However, you're at a point now where there's going to be a crossroads happening between risky assets and risk-free assets and the U.S. dollar. You've seen gold, curiously enough, in the last week or so, really trade off very sharply. And there's some very strange things happening in the gold market where gold typically will trade as it trades kind of as a proxy for real interest rates over time. And so usually the direction of gold will follow that of bond prices, usually. And there are nuances around that and there are idiosyncratic factors, but in general, that will happen. And what we started to see happen was when this situation in the Middle East blew up, gold went up in the U.S. Treasury market and rates that actually went up, not down. They tried to go down a bit, but in fact, the movement was not only not well correlated, it was actually completely, gold went on its own and actually significantly outperformed the rates market and shot up by about $100 an ounce. Now, granted, it was also very slow to correct, and it was much late in correcting relative to the huge increase in mid to longer term rates that we had that preceded that. So there's been some kind of somewhat out of sync steps where the markets have been not, their correlations have continued, but they've been out of sequence, and they've been either slow or in one way either ahead or behind. And gold's been a great example of that. So we had gold basically eventually drop off very sharply, held in extremely well, much better than expected, then fell $100 an ounce. And then you had the Middle East crisis happen, and then it rallied really sharply, much more so. And then in the last 3 or 4 days, we've now seen gold just really drop off, but platinum, other metals have just gotten killed. And this is against a nascent upturn in some of the commodity currencies like the Australian dollar and euro also, which is not a commodity currency, by the way. But we saw a number of basing patterns begin to emerge. And that was coincident also with the shift in terms of the stock market recovering as sharply as it did, and the bond market recovering. But we're seeing now a situation where we've kind of met where a lot of the short-term imbalances have probably been worked through. So a lot of the shorts have been forced out of the stock market, shorts have been forced out of the bond market. We had a pretty sloppy 30-year bond auction last week that might have, I'm not sure to what degree the ICBC hack was related to that. The market was trying to recover Friday till the Moody's news came out, and then they pushed everything down again.
Right back down. Yep.
Yeah, we'll see how it does on Monday. But the point is, all this stuff is that you've seen a huge paradigm shift in macro markets, where the net conclusion is the Fed is done. The bar for them actually moving again is pretty damn high. They may not cut rates though as soon as the markets would hope, but the markets can probably price in at this point easier an ease than a hike. And of course, this is what they're doing. Stock market, the S&P rallied 6% plus. NASDAQ, tech, semiconductors did, extremely well. What we don't know is the correlation with crypto, where we've had, crypto pricing over recent months has been, again, almost contraindicated from global markets, where it has mostly, much of the events over the last few months, there has not been a discernible price reaction to in cryptocurrency in the same way. It has mostly been focused on the expectation of potential liquidity events like a spot ETF in Bitcoin, right? Now what we've seen though is also, and this again, maybe it's very hard to say where the coincidence and where the causation actually is, if it's there, as opposed to just purely correlated markets, right? Where you think you have a correlation, but because both things are going the same direction. But in fact, is there actually a real causative effect between the two? And that's questionable. I'm not saying it's doubtful, but I'm saying it's questionable. You've had tech and you've had crypto both moving strongly in the same direction in the last few days. And again, I don't think that is a surprise. I don't think that is really any kind of contradiction, because again, you've had this huge shift away from and spurred by the Fed's own comments, basically, as well, because they made one of the things that when you look at the different, it's all about kind of looking at different how they say what they say, how the context they've said it, not just Powell, but the other Fed speakers, and there's a kind of this narrative that continues to unfold. And when you think about it, it's, when Powell then came out a week ago and said, oh, the Fed can still hike, because clearly they were probably a little bit perturbed. The market got so excited by them saying that they didn't say they were probably done, but the fact that when they talked about the dot plot, for example, and how the dot plot was still pricing one more hike in December, but that was in September, and then the efficacy as you go on into the quarter, that becomes much less meaningful. So in other words, Powell was saying, look, if we were to redo this today, we wouldn't have a hike in December. So, and this is one thing among a number of other things that were said that gave, I think, some credence to the idea that the Fed is probably done, barring some sort of need or clear need in terms of a shift in data. The point with this, though, is that the Fed's kind of leading the markets around by the nose. So here he comes down and says, "Oh, we could still hike again." Of course they could. It's a ridiculous statement to make. But this is what people are looking at, and so when you kind of step away from that and say, "Okay, it's pretty clear the global economy is weakening. It's pretty clear that you're seeing some fairly disparate events that are happening now across different economies in different ways. And you were seeing a significant change in behavior and impact of higher cost of capital and borrowing. And you have geopolitical issues that are not going away. They haven't necessarily gotten worse. So back to the story of gold, gold has dropped, 2/3 or more of that upward movement is sustained. So it's maybe back to some sort of near to fair value after the dust settles. But the point is there are some massive dislocations that are going on. And while I don't know what central banks are buying and selling gold right now, or if they have been involved in this, but the way the market's behaving is not normal. And the way it's responding to capital shifts and the way it's responding to, and this, I've been looking at markets for 25 years. So just my opinion, but things are not, there's some exceptional things that are going on. And unless you're at the bank or you're at the broker dealer who's actually seeing these flows, you don't know. But the price action is compelling. And so in some way we've seen crypto, for example, which has, throughout all the craziness of the last few months and the weakness in the stock market that preceded this pivot on Powell in the Fed, price action has been becoming incrementally more positive. And now it's just kind of exploded as well. And then we ask ourselves now, if it is the case that the major asset classes have reached the first kind of milestone of retracement and correction and kind of technically they're less short, or you have more of a equilibrium that begins to occur, then what are the conditions that are going to cause this to shift? And so unless we see some sort of significant deterioration in the economic situation near term, or we see something else, it's likely that we will probably establish a broader trading range. But with crypto, again, the news continues to be incrementally bullish, where now we have the talk of BlackRock establishing a spot ETF in Ethereum, right? And then we have the huge movement in altcoins. I mean, algo has done tremendously, amazingly, in fact. I mean, we have, but the market is extraordinarily volatile. It's the most volatile I've seen in at least 2 years. You go up and down 10% plus in a single day. I mean, this is, again, these conditions are not normal. And so there is, in the market cap has risen to like 1.4 trillion. We had 3 times the volume last Friday that we had the Friday before, for example. There are a number of kind of internals which are becoming much more dynamic. And so I suspect, again, like the cryptos rally broadly with the rest of the markets. Now the issue is how much more can it go, and what's driving this, and to me, and this is something that again you may have a lot better handle on, but as it relates to this BlackRock ETF, which is obviously they're not the only ones, of course, too, but the real issue is if the public comes in, how is BlackRock going to get the crypto to make the ETFs, right? So BNY Mellon will be the custodian, and we'll go through different exchanges, I'm sure, to purchase the Bitcoin. But there's going to have to be a massive on-ramp, right? And so I'm just wondering that, to me, this is the reason why it's so bullish, because not just for people, it's the dynamic kind of expansion of liquidity. And if BlackRock can source in size, in scale, Bitcoin and Ethereum, that is super bullish for the general industry and process. And so,
Yeah, I couldn't agree more. We were talking the other day on the next block, we were speculating on if a Bitcoin ETF approval would actually be a sell the news event, similar to how the futures ETF approval basically marked the top of the market at that year. And I was saying basically what you said, that I think it would have the opposite effect. I don't think it would be, it's an apples and oranges comparison, because you have a futures ETF over here, which, really just increases the ability to short the market, if anything. And then over here, you've got a spot ETF where institutions would be forced to actually buy spot Bitcoin, which would, increase the liquidity in the space. So I do think it's an apples and oranges comparison. And although one did have the hype, the futures ETF had a lot of hype back then. I remember when that was going down, but it had, the opposite effect that the market wanted. I do think we'll basically see the opposite of that happen with the Bitcoin
I mean,
ETF.
there is, so you're raising a very, very interesting point, which is that there is a tendency. So, for example, when the CME would introduce new contracts, typically, and others like this too, it's like the old, it's like if you're on this, if you're market or you're on the cover of the Economist, you're probably at the top, right? So there's a bit of market behavior associated with these things, where we're always in the process of trying to look ahead, not behind. And so yes, I agree that these are apples and oranges and very different. And CME and new products that have been hyped up a lot have a tendency to reach the peak when they're introduced, and then after that fall back in terms of volume or usage for a while, until the market actually recovers. And if they're good, then ultimately it will prove to be very, very constructive and positive. It may be the case that when this finally comes out, you do get a bit of retracement, just because the market's long short term. I wouldn't be surprised at all by that. But the point, though, is if there's a fundamental shift toward a broader base of capital coming into the market, that is unlikely to disappear or to go away, unless the market totally collapsed or something crazy happened, right? But a lot of what we're trying to do, and this is where crypto is a very interesting animal, because we don't have a way to value crypto necessarily. And because we don't, and I love to hear that someone does have a good way to do it. I'd love to hear about it. In terms of that, again, notwithstanding the various ways in which we can try to substantiate the price for different, streams of revenue and things like that. But there is the fact is that, or the point is that, we're dealing with a market that requires belief and requires, and you could say the same thing is true with fiat, right? It's a medium of exchange. It's a, like anything, it's that the marketplace believes that this has value and therefore they use it, right? And there's some key reasons we could postulate why fiat and others that have been around, by virtue of their very duration, are a different story. However, as we've said, Bitcoin now has been around for over 10 years, and financial markets are terribly efficient, and it might have been a bubble initially. I was just reading something about how some guy had, there's a wallet that finally moved that hadn't moved in over 10 years, and it acquired like 1,000 Bitcoin at below $5, back 10, 11 years ago, and now it's worth $30 million, right? Or more than that, right? 37 million or whatever by today. So the point is that the value proposition continues to evolve. The way in which the market analyzes what that value proposition is continues to evolve. There is no yet, there are a couple of different pricing models around traditional assets that are based upon, that are grounded in a strong degree of statistical reality, that we don't have in crypto. And so, having said that, and it's based upon the marketplace's agreement coming together that these things are going to be used and have a store value and will remain. But having said all of these things, so we can't really say where Bitcoin should be, relatively speaking. There's a Matrix report that was out talking about, I think, way over $100,000. I mean, the guy that did the work, there's a brilliant guy, but it's just and that's based upon as scientifically, as analytical as he could be, which I respect. But the point is that we have this unfolding process, and we don't really have a backstop yet. All we have is a relational backstop. So this is where it's traded. We know the history, but we don't know where it's going to go, of course. And part of our role as market practitioners is, if we find ourselves constantly affirming what we believe to be true, or looking, for example, again, this is a long-winded explanation of your, buy the rumor, sell the fact. It's an old trading analogy. And the point is that once the market knows about it, it's already in the price. This also goes into the efficient market hypothesis by our friend Eugene Fama, who was my professor at Chicago. But the point is that there is something to be said for the efficiency of the crypto market. And when we, in this process of assimilation, and the information assimilation is also not as ubiquitous, and I think in some ways, and I may be wrong, but it's not as efficient yet as it is in TradFi. You have a number of wire services, you have all these things, so you don't have the same kind of process of information aggregation and dissemination in crypto yet that you have in TradFi.
I feel like that's fair to say, yeah.
Okay, and that represents an inefficiency in some ways, and again, this is not, I guess, in some senses, not at all surprising, because you're seeing the liquidity profile continue to improve. You're seeing the marketplace itself become, as it becomes more liquid, it becomes more efficient, and those pricing disparities that and opportunities around that will continue to be more competitive, and all of that makes sense. But it is related, I think, to the availability and the flow of information as well. And certainly the constituency of market participants and that broadening aspect that this whole ETF thing represents. The point is that we're at as we look forward, it's the old known knowns and unknown unknowns, right? So at this point now, what is the unknown for the market, right? And of course, we can't answer that by definition, but is it the case, as some people said, that crypto is acting as a safe haven now because you're seeing these other things that are going on? I'm not quite sure I agree with that, but in some sense, as we see this continue to evolve, it's evolving in its own kind of way, and just like the regulators, there's still, I mean, part of the reason why the SEC didn't want to approve, or the biggest reason why they say they didn't want to approve the ETFs, is because they couldn't, because the exchanges they were buying them from were not regulated, or they were not, transactions were not verified, and all the other things that they, obviously a lot of stuff, some of this is a specious argument, of course, but the point is, though, that the process of regulation around crypto, and then even more around DeFi, the regulators don't, some of them, not all of them, some of them do fully and very well understand what's going on, but some of them don't. And I think that because we're dealing with new technology, this still represents a change in the approach. So who knows what's going to be around the corner for us, right? But the sentiment is very positive right now, very enthusiastic. I don't sense that people are at a point yet where we feel like they're ready to say the bear market's over, crypto winter is over. What will be very interesting to see, I think as we look forward and we say, okay, ETFs, how much are those worth? And that was the Matrix report thing, saying, okay, they get the ETF, this is what it's going to be worth in terms of market cap, and why they come up with the price that came up, which is all very sensible. But as we look ahead, we say, okay, there might be 3 or 4 primary things that we can look at and see how the market responds. Because the reality is, if you're dealing in pure capital right now, without And this is, again, a huge area of growth is the real world asset or economic use cases associated with this. Something we're very much focused on developing right now as well, which we will hopefully have more news to talk about that in a few weeks. But we are basically looking at, if the economy slows sharply, if the Fed is truly on hold, then ceteris paribus, all things being equal, which of course they never are, that should be supported for crypto, because a asset with cash flows far into the future will see an increase in its NPV if discount rates actually go down, which we would expect to happen. So you would see broad-based support. I expect that to happen. If we don't, then that's, again, notable. If you see a big geopolitical flare-up and the market sharply responds in a timely way, where you have some indication, because, again, this goes back to this economic behavior process, right? Where, because we don't have a unified valuation methodology for crypto, we're watching the aspect of the market behavior and the economic economic behavior around that becomes even more important, and more important in the sense of observing how and where sentiment shifts and how price behaves around certain key points and certain key news things. Because, again, you don't have the same there isn't, like the point, for example, if you were to see, for example, the US 10-year Treasury go from 4.6% to 3.6%, that has massive implications in a number of ways in terms of real economic implications. Has implications for the US dollar, has implications for the US economy. It has, across the banking system, across the asset, but what happens if Bitcoin goes from 37 to 60, or from 37 to 20, or 37 to 15, right? Or 37 to 100? What does it actually change, right?
Right.
Outside of people's P&L,
Yeah.
and does it? I mean, obviously, the rising market has a very important influence on VC capital and innovation, and money coming into the space that is used to develop some of the very important things that are going on. A lot of these layer 2 projects, you're seeing increased use and use cases around them, and a lot of really interesting things are happening there. But the point is, though, that outside of that, how much does that impact the real world, right? And again, this is probably something that I'm sure a lot of people will have a much stronger opinion on than I have. So apologies for my shallowness here. I don't see a big I don't see a huge impact at the moment, outside of the fact that it's either going to make the crypto world richer or poorer
Right.
based upon that. And I think that that's kind of where this strange tautology exists when we look at the prices and we look at what's happening. And clearly the market's there is a clear progression, there's a clear forward movement in the industry, in the technology, in all of these things. There was something I was looking at, where looking at DeFi storage and how some of the layer ones are going to need to maybe start looking at that instead of being reliant upon CeFi storage. And even though it's more expensive when you look at the longer term, there's some really interesting areas of development around that. The point is that we're in a place where this will continue to move forward. You have still a significant amount of I'm not going to say believers or unbelievers, but you have, because of the lack of regulatory clarity, and the and the lack of regulation for a significant part of the global asset market. As a professional money manager or investor, your focus is entirely upon regulated products and markets,
Yeah.
and as it has to be, right? And because of that, what that means is that in general, because these are not yet fully regulated or regulated in parts, um, the large component of the investment world still has not had to acquire the domain expertise or knowledge, experience, understanding yet of crypto in general. So there's an educational component that is very much aligned with the regulatory process going forward. And that represents another potential, opportunity and challenge. But the market, obviously, that will come about, I'm sure, pretty quickly. And clearly, the regulation leads the knowledge base of that. But the point is, there's a big gap still in terms of TradFi, in terms of people's understanding of what this is, and it's highly likely that until we see some sort of explosion of real world use cases in crypto, that the regulatory process, because of the enthusiasm, because of the levels of adoption, all of these things are what they are. That it will be viewed. The more people use it, the more legitimized it becomes.
And the more necessary those regulations become as well.
And exactly. So and and so as that happens, then I think we will find more, more use cases for it. Again, like I guess the point is that we don't, again, going back to kind of behavioral finance, it is, if anything, even more important in crypto and digital assets than it is in traditional finance. But again, it's all in some sense, we may not have all of the boxes ticked for understanding yet what it's going to do and how it's going to, what the economic outcome of these are going to be. But there's still, at the end of the day, humans that are making decisions, right? It's not AI, it's
Right.
humans, right? And humans are emotional animals. And
And even if
ultimately,
it is AI, it's the data it's being trained on is human data generally. So it's,
right. So, I mean, I think I'll be very curious to see how the next few weeks, how it's my expectation U.S. economy is going to slow a lot sharper than what people expect. If that happens, how will crypto react? To your point, as we find clarity, if we find clarity from the SEC on these ETFs, how will the market then respond to that? Because it's likely that, I mean, one of the paths I can see is that you begin to see clarity. The market is valid. The market prices are validated, but people have made a lot of money. They sell off some of their long positions. The market drops 5 or 10%, finds new buyers, and then it goes up more again after that, as it finds a wider capital base to come in. But yeah, it's going to be, I think, the next 6 weeks until the end of the year. It'll be a very interesting time to see how crypto does and whether it actually decouples, or not. Because ultimately, the question to be asked as well is that while we've reached, and when you look at the risky asset market, we've reached a point where, again, with the rally of the S&P back to 4,400, the NASDAQ back where that's gone to, we've reached a point where there should be some pretty strong headwinds that are starting to come against the market, and we'll need further justification to see further higher prices from there. And if the economy slows down a lot, I don't think the liquidity trade as it relates to the supported risky assets can survive much longer in the current stage, which means then what were tailwinds are going to become headwinds, because of course if the economy does slow down, this is not good for stocks ultimately. Okay, so yes, liquidity overall over a long period of time is what does drive stock prices, but if earnings come down, this is going to affect stock prices and must do so if the economy decelerates sharply. So if that happens, then are the prospects that we see this decoupling between semiconductors, NASDAQ, and crypto, or not? Or does that prove to also be deleterious for prices of crypto as well if people need to sell? So,
do you have any speculation there? I know it's obviously tough to speculate, but do you have any opinion there? Because crypto's a unique asset class in the sense that it's never really experienced its own recession. It was created basically right as in response to the '08 recession, and since then we haven't really had anything, at least to that significance. So do you have any speculation to what could happen, or is it more a wait and see?
There is, I think it has to be wait and see, because even if we look at what happened in 07, 08, we had a series of events that culminated into the crisis. First, we had the housing market. Then we had volatility being super compressed. And we had all these various financial innovative products like CDO squared and things like that, which were all basically ways in which they could continue to leverage the low vol environment and create a decent rate of return effectively, and based upon the house of cards, which was the housing market. But into this issue, 6 months into it, into 07, we then had inflation fears rise. We had some commodity price increases. And we haven't touched on crude oil at all this time, but crude oil has dropped by about $20 an ounce. I'm sorry, $20 a barrel. It's down about 20%, more or less, from the highs. So, and basically what happened then was you had an increase in interest rates by the ECB in early 08. Jean-Claude Trichet was the worst central banker in the world, in my opinion. And he caused rates to increase, screwed just about everybody on this ridiculous inflation concern. It was very clear to market practitioners and people who were observant that there's a massive asset deflation and recession coming. And this is the way we were positioning ourselves. And this is something, and so this caused yield curves to sharply flatten instead of steepen, and of course it was entirely a bad move and a big mistake, because they were then cutting rates sharply after that, and then the global crisis followed. But the point is, through this process, for example, a traditional safe haven like gold actually declined by about 20% as the crisis was unfolding, and that was not because it wasn't a safe haven, but precisely because it was a store of value. And what happened was people there's a global capital call, because the system was over leveraged. And then the banks didn't have the liquidity and they were screwed. And then what happened was people sold gold because they needed to raise capital to meet margin requirements and other type of funding needs. And gold dropped. And then it found its footing, and then subsequently exploded after that, or went on a very strong bull run. There might be some analogs to crypto in the current context, in a similar type of way, if you see some sort of global capital call. But the thing is, I don't expect that to happen. The U.S. banking industry is not. They have a bit of an issue right now because net interest margins there's $1 trillion+ of losses right now, and they're held to maturity books. The cost of funds have gone from 0 or almost 0 to 500 basis points. So they're kind of upside down in some ways. This is not exactly accurate, but I'm mixing metaphors a little bit here in terms of bank balance sheet analogies and stuff, but there's substance to that. So the point is, the banking industry is, and they're likely to be under pressure also for quite some time, because again, the negative or inverted yield curve in effect is directly challenges the bank's traditional model of making money, which is, borrow short, lend long. So if you're lending long at a lower rate than you're borrowing short, clearly it's unprofitable. So anyway, and with the slower economy, tighter credit conditions, increased delinquencies and bankruptcies that will come, and all of these things, obviously this represents stress on the bank loan books and earnings and capital and all of these things. So but we're not looking at some sort of massive, as far as I can tell, any kind of massive, huge problem like we had in 08. So in other words, it's unlikely crypto is suddenly going to have some capital call. Crypto is going to be sold to meet capital calls because they have a need for it to be deployed or used elsewhere. But that is a small possibility, right? So if that's not the case, and you do see the worm turn in terms of the global economy and things slowing down sharply, then it just means likely if there's less capital to support the TradFi markets, crypto is still such a small part of the overall global credit system. So the latest credit, it's somewhere in the neighborhood, again, depending upon what source you look at. But global credit's 230 trillion or so. Global equities another 120 trillion. But basically, somewhere 360-ish trillion. Crypto 1.5 now.
Yeah.
Is a third of 1%. So it is unlikely. And the other thing too, of course, because we're still figuring out what the real world use and economic value is to crypto, that if you see a significant recession, that lack of clarity could also be, to some degree, represent some insulation against wider issues too, because there isn't as clear of an economic channel between the two in that way, right? So it may actually, I would expect, in fact, probably will outperform. The degree of outperformance is the question.
Right.
I don't see, if, for example, the stock market were to drop by 10%, the issue is we're dealing with an expanding ecosystem, an expanding asset class. And because it's expanding, it's probably dangerous to try to compare TradFi, long and mature and established asset classes, to that in the same way, because you're really not comparing the same thing at all.
Yep.
And that's why this liquidity issue is so important with the ETFs and the potential wider impact it means for capital coming in.
Yeah, and the last point I'll just add to that, I know it's getting late, we're a little over the hour, and it's now midnight where you are, but
Longer than I
you know,
expected.
I am curious with the potential influx of institutional money, whether it be through ETFs or what have you, if over time, as more institutional players come into the space, they devise more reasonable ways to value the cryptocurrency. Because right now, the only ways that I really know, we talked about in the last show, is Metcalfe's law, and then there's people like to try to use the market cap to TVL ratio in a similar way that they look at price to earnings ratio, which I do think there's some flaws in the logic there, but outside of that, there's no real way to value these cryptos, as we've mentioned throughout this episode. So I am curious if as time goes on, as more institutional players come in, and they find a good way to value these things.
I mean, it's a really important point. I think a couple of things briefly. One is that because it's still a developing, growing asset class with a broadening understanding of its use case and when, where, and how it's applied, that represents therefore a minimal investment allocation by traditional money managers. So in other words, they're never going to establish a lot. But again, to the point of the current market positioning and size, a 1% allocation would triple the size of the current market cap of crypto, right? Ceteris paribus. So that being the case, at the same time, as we look at the crypto markets and say, okay, well, very, very true what you said. People will continue to look, as you would, as a relative value type of connection, where, again, like most asset classes, most things are all, a lot of the value is derived from a relational component. So if you look, for example, at different equities or companies within a certain sector, you'll look at what is the, you'll look at some of these statistics within that sector to see where and how, whether this company might be fairly valued or undervalued or overvalued relative to its peer group and relative to these things. And in some sense, when you broaden that out into different, industrial sectors, and you broaden that out into different, and so on and so forth, right? As you go out the pyramid, so to speak. Crypto, I think, is going to be the same way. And the leverage inherent in crypto, though, is still overall very small, because you still have a real, you don't really have a real credit system yet built up in crypto. In some way, it's all credit, right? Which is kind of an interesting thought. But it is something where, again, because you don't have that, and because like what we do is mostly fully collateralized, for example, right? Now it's a separate issue, but what we're doing is we're focusing less on the value, but we're focusing more on the way to extract value from the actual markets, which mean that we're not saying Bitcoin should be 20,000 or 100,000, but we are saying we can take the market and the volatility that this asset, as any other asset on the planet has, there's a volatility which can be stripped and priced. And that's where it's very interesting, and we can create risk management, yield enhancement around that. But again, those are good questions you're asking. I don't think that we have answers yet. I don't know to what degree this CBDC growth will impact, if at all, Bitcoin and ETH and the wider ecosystem of altcoins and various applications that are being built. And it seems pretty unlikely. It seems that there will be this parallel process continuing to move forward. Anyway, but yeah, that's still searching for answers.
Yeah, I mean, I feel like that's a never-ending, it's a never-ending search on that one.
Yeah.
But everyone, I appreciate watching to the end of this episode. It's been a little bit of a long one, but I think a good one. If you, for some reason, think you know which way the market's heading, head on over to algorand.finance. Check out some of those option vaults. There's some great algo vaults. Go BTC, Go ETH, all sorts of different ones. I'm sure over time there might be more added as well.
Yields as well, because the Algorand Foundation is incentivizing the DeFi ecosystem. So now, even for example, for the ETH and the Bitcoin, we're able to not only extract the volatility, but to get a very, very healthy incentive on top of that. So it makes it quite compelling.
Yeah, absolutely. I mean, I couldn't agree more. Some of these yields are quite compelling, and some of the win rates on some of these vaults are pretty compelling as well. So definitely head on.
Which we hope will continue if algo continues sky high.
As with everything, historical data doesn't determine future success.
We do our best, and basically the last part of this shameless plug, and thank you for bringing this up, is that it's based on a continuum of time and consistency over time. So our win rate in this case, in some cases, are very good. We pay a lot of attention. We're very assiduous in our application and looking and trying to understand where we can extract the best bang for the buck for the least amount of risk. But we have no control over the market. So it's a balance. It's a balance of probabilities for all of these things, and it means that ultimately we will get nicked once in a while. But if we're consistent in the approach and the application of that over time, these strategies have historically worked over time in TradFi, as they will and they do in crypto as well. So it's a matter of basically sticking with it. And yes, one time out of 20, maybe we lose money, or you make less money if it's a covered call, for example. But overall, you will make, there is a strong chance, not financial advice, there is a strong chance that you will, over a sequence of time, make a nice return using products and strategies like this. We are also creating additional strategies which will create different alpha exposures or risk management exposures. For example, if you're long crypto and you want to hedge your position, we will have some hedging vaults. We also have now, we're finalizing some accumulator vaults where you can deploy your stablecoin and you can acquire crypto at a discount to present market levels if the market trades down. But until it does, you'll continue to achieve a nice rate of return on that. And there's some things we're looking at with gold right now as well. And there's some quite different ways in which we can express and manage the risk and the volatility to create value through this structured product medium that we have. And this is a market-based approach, so it's using liquidity. It's a competitive process. And so in that way, we have a very important market niche and a very important part of the market that is developing and needs to be developed further, because while all the other great things are happening, a market and risk-based management process is as is in TradFi, it's a hugely important thing for a variety of market participants.
Absolutely. I think that's a great way to end this episode. Everyone, thanks again, as I said, for joining us for today's episode. Catch us again in 2 weeks for episode 3. And yeah, like and subscribe if you haven't already. Go to Algorand.finance to check out some of these vaults. Check out the video description down below for more links and ways to support the channel. And yeah, hopefully we'll catch you all next time. Actually, before we go, I should mention as well that Thursday, the weekly show for The Next Block, has Gary Maloof and John Aled Woods coming on, the two CTOs, CTO of the Algorand Foundation and CTO of now Algorand Technologies. They'll both be on Thursday. Yeah, 1 p.m. Eastern Standard Time, or 10 a.m. Pacific Time, wherever you're tuning in from. Definitely check that out. Subscribe, hit the notification bell so you don't miss an episode, and we will catch you all in the next one. Thanks.
Thank you again. Thank you everyone for watching today too. And any questions, please contact us through the usual social channels.
Absolutely. Take care, everyone.
You too. Thanks a lot.